Welcome to Chit Chat Stocks. This is our weekly Power Hour episode. We've been off for a little bit on these Power Hour episodes, so this is our first one back in the new year. Brett has been on vacation here. I guess I should introduce. I am one of the hosts, Ryan Henderson, and I'm joined as always by the one and only Brett Schaefer. I guess Brett, any uh any anecdotal evidence from your time in the land down under? Was there any companies that seemed investable out there?
Well, there's not many public companies in New Zealand. I was in New Zealand, not Australia. I saw
Is
some
New
Celsius cans at the
Ooh.
store. If people are excited about that. It's not really a big market. It's probably the size of a single US state. But either way, seemed like those were popular. Fever Tree, those drinks were down there. And I have to say, it makes me more given the places I stayed on the trip, hotels, Airbnbs, hostels, stuff like that. I think people still underrate the affordability of Airbnb versus some of these, what I would call average and overpriced hotels. That was one of my big takeaways, and that's probably one of my biggest anecdotal evidences.
Hey, I had a similar experience. If it's, a night or two, you can kind of get away with the hotel, but yeah, I think more than anything more than 3 or 4 days, Airbnb is certainly more affordable. We're gonna
Yeah,
get
and
into Yeah,
and
go ahead.
with how should I say it? Big resorts, stuff like that. If it's a very nice hotel resort and it's gonna be very, very expensive, that's gonna be better than most Airbnbs. But those average ones where I really feel like they just are overpriced, I think you can get a much nicer Airbnb for that. And I see so many people still at these resorts that I think over time we'll be switching to alternative accommodations. But let's get into the episode, Ryan. Maybe we can talk about that in any specific segment.
Yeah, absolutely. We got a lot to talk about this week. There's been news over the last 2 weeks, so plenty to discuss. But before we do, I want to mention a word from our sponsor, our friends at Public. If you're serious about investing, you need to know about public.com. That is where you can invest in everything: stocks, options, bonds, crypto. They even offer some of the highest yields in the industry, like the bond account's 6% or higher yield that remains locked in even if the Fed cuts rates. What sets Public apart is how they give you the tools you need to make informed investment decisions. Their built in AI tool called Alpha doesn't just tell you if an asset is moving, it tells you why the asset is moving. So you can actually understand what's driving your portfolio's performance. Public is a FINRA registered, SIPC insured US based company with a customer support team that actually cares. Bottom line, your investments deserve a platform that takes them as seriously as you do. Fund your account in 5 minutes or less at public.com/chitchatstocks and get up to $10,000 when you transfer your old portfolio. That's public.com/chitchatstocks. This is paid for by Public Investing. Full disclosures will be in the podcast description. Where do we want to kick things off, Brett? I think the biggest news is probably the Disney stuff. So we can go there if you want.
We could do that. You want to save Trevor Milton for the second one?
Yeah, that should
That's
should
a
that be
fun
your bubble
segment.
watch?
Yeah, I guess it kind of relates to Bubble Watch, but not this bubble, the last bubble. Someone said that he's like one of those Japanese soldiers stuck on the islands in the Pacific in World War II, and they find him in 1970 still trying to fight.
Yeah, I like the analogy. Let's save it for a bit. I mean, I guess you got two different events for your bubble watch this week, but I want to talk about Disney. We have been, I don't know, maybe vocal Disney critics, you could say, more so Bob Iger critics than anything else, because the business still seems okay. But there was some news that came out this week that Disney is essentially acquiring 70% of Fubo. Um, I- but Fubo had an ongoing lawsuit with Disney and a couple other media companies. I can't remember which ones they were, but basically the companies that teamed up to build the venue that like sports first streaming platform. Um, Fubo sued them because in asking for sports rights from those companies, basically the company said no, you have to also add all these other content rights as well to offer whatever you offer, which was basically Fubo didn't need them. And so Fubo was basically getting charged more than they had to. And then when they turned around and built Venue, they gave themselves kind of preferential treatment there. So there's an ongoing lawsuit. Essentially, this settles the lawsuit. So it's kind of an injection of capital. Disney gets 70% of the business. There's also a term loan in there as well. There wasn't that much depth into the financial terms, but basically the thought here is that they are going to Fubo's still going to remain a like standalone publicly traded company. They're going to integrate Hulu Plus Live TV into Fubo. Um, Coming out of this, they will be better capitalized because they'll have that injection of capital from Disney. They'll also have 6.2 million subs in North America and more than $6 billion in annual revenue. And they'll be growing revenue 10% plus, essentially, according to their presentation that they put together. Now, I've seen something that said the combined business will be cash flow positive immediately, and they are targeting 5% adjusted EBITDA margins in 2026. Take that with a grain of salt. Don't know what all the adjustments are there. But basically, they're projecting that they're going to save costs. There's going to be content cost savings, which I guess makes sense if you're licensing from Disney. Um, there's going to be advertising optimization. I guess not sure how exactly that works, but I assume they have better in Disney probably has better inroads with advertisers. Maybe there's better tech there as well. And then there's just the standard kind of operational efficiencies. There's probably duplicate roles between Hulu Plus Live TV and Fubo, so probably some layoffs will go on there as well. Basically, they're projecting $120 million in run rate cost synergies. Now, most acquisitions never seem to hit those synergy targets, and from the ones I've seen, I guess I'll pause there because that was kind of a lot of news. What do you think of this deal? Does it make you any more or less interested in investing in Fubo?
I guess more, but the interest was negative, absolute zero. So maybe it's slightly higher, but still, no. Come on, not touching this whatsoever. Why would I touch? It's like a legacy media thing wrapped in a virtual cable bundle. What's the point of it? I mean, YouTube TV just sells at a loss, and Alphabet doesn't care. Okay, great. Like if Fubo has some local sports that they can offer, that they only can offer. Like they're the only person that can offer, or excuse me, company that can offer those local sports rights to people. So they're forced to pay it if they don't want to pay the traditional cable bundle. Is that a long-term sustainable business model? I'm not sure. I look at these presentations and all I see is lie, lie, lie after lie. It's the same thing over and over. And I have some advice for these people. Instead of spending $3 million for these consultants to make these, you can give us $10,000 and we will slap random numbers on some presentations for you. And it will be just as accurate as what you're putting out right now.
But
I
will it be as pretty, Brett?
yeah,
Can we make it as pretty?
well, it's the age of AI, Ryan. I think we can do it. I think we can just tell Chat GPT to do it right here. I personally, in my personal life, hate this because I want Fubo to die and get rid of the local Seattle sports rights because I hate having to pay that if I want to watch that without getting the cable bundle. It's wildly expensive and egregious to pay $90 just to watch a baseball team every month. And I don't think this is smart for Disney. Aren't you trying to get away from the traditional model? Aren't you trying to go D2C? It just seems like just a mess. And they've been a mess in their live TV, in their traditional media for a long time now. I still don't get the strategy.
Yeah, the other thing about this is it's like and it seems that a lot of the content or the legacy media companies that are converting to streaming TV don't really seem to grasp this because maybe they have such a good understanding of their product that they just think everyone else does too. But these kind of deals are just a little confusing to customers. Like, okay, I'm getting Hulu Plus, Live TV, and Fubo. Like,
No one even knows
okay.
what those are to begin with.
Yeah, it's like I think part of the reason Netflix has done so well is it's such a simple strategy. People know exactly what it is. Like You're getting content on Netflix. If it has the little N logo, it means they made it. If it doesn't, they're licensing it. Boom. It's easy. You have a finite time to watch it if it doesn't have the N logo in the corner. So just yeah, I think this is a mess. I would probably predict this doesn't go particularly well. We have said on this show before that there isn't that much appeal to just owning sports rights. Because and just to reiterate this for anyone who isn't familiar with the media landscape, but the negotiating or the bargaining power, for the most part, belongs to the sports leagues themselves. If you negotiate a deal with the NFL to have their TV rights over 5, 6 years, well, in 5 or 6 years, whatever margin you make, the NFL is going to come back and say, okay, we're raising the price that much, right? It's like you're taking a big gamble on sports. Fubo has proven that they can't be profitable with this model. Free cash flow has been negative for, I think, basically its entire public history.
It's an unsustainable business. Yeah. Maybe Disney can make it work because they have other things to sell and you can have it as a almost a retention tool as Amazon does or something to just lock in your subscribers and you make money in other methods. But standalone, it's really, really hard. And especially with Fubo's model, I mean, you're competing with YouTube TV. They don't care about being profitable on their subscriptions.
No, no, they don't. And YouTube TV is really the elephant in the room there. There's also uh they had a slide in their presentation of like basically like where they're positioned relative to the competitors. And they're like slightly bigger than some of the other ones, kind of middle of the pack. I think on pure streaming TV, they're like the second largest, but
They offer the same stuff.
yeah.
It's all the
And
same.
yeah, it just feels like this was kind of an expensive way to settle the lawsuit
True.
more so than
Yeah.
anything
Yeah.
else. They said
Yeah.
basically the legal dispute is done. Okay, we own Fubo.
Great.
Either pay a settlement or just buy them, I
I think
guess,
the
is the
settlement might be
strategy.
cheaper given how much Fubo is going to lose money. I don't see how they, sure, they can say they're going to be target adjusted EBITDA. Those are fake. Like, that's not real. Your cash flow is still negative. I don't get it. I don't get the strategy here. I don't get why Disney's trying to get bigger. Yeah, I don't like it. I
Yeah.
don't like it one bit. All right. What other topics do you want to hit?
Well, I do have kind of one of my listicles that I do that actually is kind of interesting and potentially actionable. And there's a couple companies that, well, we've looked at in the past, and there's a couple that I actually am quite interested by, but we can save that as well. Do you want to talk Trevor Milton, bubble
Yeah.
talk?
Do
What's
you
our segment called again here?
Yeah, yeah, bubble watch. I'm calling it Brett's bubble watch. I think honestly, I think it was the first episode before we went on Christmas vacation that I did this. Like it was the first time I did this segment. Did it mark the top? It might have. I think I'm trying to jinx it every week as much as possible. We're going to do this each week because the markets seem to be going sideways and a little bit down after starting this. So hopefully, hey, it gets exciting again and we just don't go up and to the right. But we're essentially just looking at what we're not calling it a bubble. But we're saying stuff that might be on bubble watch. You know, is it a bubble? Is it not? Are we getting into those animal spirits? Are we getting back to everything goes up no matter what? You guys know how it goes. And one thing I saw this week, I think I might be on the ground floor here. Trevor Milton. Do you think people know who that is, Ryan?
Refresh it for anyone that
Okay,
doesn't.
the founder of Nikola. He pronounces it Nikola, like Neekola. I don't know if you watched the video. I think it's Nikola, but hey, it's his own company, so maybe that's how he wanted it to be pronounced. And it was that fake hydrogen fuel cell truck company that was going to revolutionize the semi truck market, and they got caught by Hindenburg Research. It was actually the first, I believe it was the first short selling report that put Hindenburg in the limelight and has gotten them much more notoriety. They basically caught them faking a video where instead of the truck actually being operational with an engine or battery or however it was going to get propelled forward, they just rolled it down a hill and they had him in the car waving and they didn't tell anyone about it. So he's back on Twitter after a 4-year hiatus He has a Twitter account with only 500 followers, so I would say get in on the ground floor, guys, because this is going to be entertaining. He's got some videos here, and he is only following two people, Ryan. Elon Musk and the Department of Government Efficiency. Maybe he's eyeing a cabinet position. I don't know. But besides the point, he had this tweet and he had a video associated with it. And I'll just read out what he said. Quote, the short sellers and government were able to change the story and rewrite the truth because the company refused to stand up and tell the truth. Any public company raising hundreds of millions of dollars from partnerships with big names goes through a due diligence process with the investing party. The SEC is then notified of these partnerships and then ensures compliance through appropriate filings, all of which were correct. Nikola met all SEC and due diligence requirements during my tenure, maintaining full transparency and accountability. Despite public narratives, no evidence ever showed regulatory breaches or misuse of funds under my leadership. Not $1! Exclamation point there. Hashtag facts only. I would say there could be some other facts only that we could add to the story, but is he trying to say that just because they filed with the SEC, they're not a fraud? I mean, did Enron file with the SEC?
Yeah,
Did
it's
WorldCom? No.
this is from my experience and what I've watched is that you don't get two shots at this. Like if you're going to be the revolutionary innovator and you go fraudulent once, you make that mistake, you get caught, everyone forgets about your company, there's no rebounding. So I would bet we are not talking about this guy in a month.
Yeah.
Maybe he tries his hardest to make some noise, but yeah. 500 followers, he's speaking into an empty void. No one
I'm
really
following.
cares
No,
anymore.
it's not empty. I'm there. I'm
Once
following him.
once
I,
you've lost a whole bunch of people money, which he has, they really don't want to hear you talk again. Is kind of what it feels like. Um, I would suspect this guy that's trying to revive Enron will kind of feel the same way.
that
Enron doesn't
well,
get
he's
two shots at it.
that one's a pure scam. That one's
Who?
not even. That's like a joke. That one's a more of a joke. Like it's more of just one of it's almost
Yeah.
like a one of those YouTube not scam artists, prank videos. The worst people in the world. Those you know
Yes.
YouTube prank people took over a company or tried to say that they're doing this. It's essentially what that is. This is
What
a
are
little different, but either way, scammy, scummy, all of the above.
what are some other examples of people trying to revive their reputation from the dead?
Hard to think off the top of my head.
It's
Who are
probably
some of
because
the note?
you don't hear him coming back. Maybe.
Oh, Wolf of Wall Street guy.
Yeah.
He's been tweeting. I don't know what he's up to. Seems like he's up to a lot of scams. I would bet if Sam Bankman-Fried gets free or is able to tweet again, he's gonna try to start defending himself. That guy's a sociopathic liar. All of these people. The Enron guy that went to prison, he's now. I think he might be a little bit reformed after his prison time because he teaches people how to identify fraud. Kind of like those hackers that get hired by the FBI or CIA. But can you think of
Yeah.
any?
No, not really. Um, it's I can't think of anyone that has successfully like really come back from it. I guess you could say, and this wasn't necessarily like fraudulent, but Ernie Garcia, the CEO of Carvana, has kind of successfully taken his company back from the dead.
Yeah, some people might argue fraudulent, but I'll
Correct.
say we're on the fence. We don't know.
Unproven.
Yeah,
But yeah,
unproven. Yeah, if any court takes that, we there's no proof for any of that.
yeah. So, well, it's kind of a bummer to see Trevor Milton back. I had an anecdote. I I, I kind of want to revive this segment. We used to do like anecdotal evidence every week. I think it was like more so related to companies, but I want to do like anecdote of the week, see if anything's actionable, what we see in the
Okay.
real world. Slack. I I wish Slack stayed public. I think it's a good business.
It was
And
probably
I'm
just run with bad expense. The operating expense slide was probably just too was overrun when they were public. I mean, because they were just losing a ton of money.
probably, yeah, I mean,
People stick with it.
they still got a nice premium buyout from Salesforce. It's a very, despite having lots of like lower cost solutions, like I think the Microsoft whatever version plus Google Chat, that kind of stuff, it's still very sticky software. Once you've got like a team really running on that and you've got a whole lot of information that's been stored in Slack, you kind of don't want to switch. So I don't know. I kind of wish it was still a public company. Um, don't know why it kind of came across that this week, but yeah, they bummer. Salesforce still carries on. Did you see that
Yeah.
bit about someone was complaining about like Salesforce? They just keep increasing prices. Did you see this?
Yeah, I saw that from Guy Spear had a bad moment there, famous investor, where he said, "We can't leave Salesforce. They keep raising prices every year." And then he concluded it was a Ponzi scheme. I would conclude that as a good business. But my other question is, you run an investing firm. What, like, you can't just say buy? I don't
Yeah.
get it.
Yeah. Also, why do you need a CRM?
Yeah.
Like, what's it's? Are you? Do you need that for clients? I feel
Yeah,
like you could
exactly. Like,
probably
I
manage
thought you
that on
just
a
had, like,
spreadsheet.
100 clients. Yeah.
You had like your administrator or whatever your don't you have like an admin basically account admin portal for everyone, so you don't really need a CRM, but whatever. Um, anyways, yeah, I think that was probably like describing one of the things that's great about the businesses, but or
Just think
the
of how
business in this
much
case.
Just think of how much Slack's gonna get better when Matthew McConaughey starts adding AI to all of this stuff. I thought it was funny that now they call it, and I looked it up because, hey, I agree with you. I'm on some teams that are in Slack. They're stuck on it. They're probably not gonna leave, and they can probably slowly raise prices for a long time. Their tagline now is Slack, AI work management. Just say it's chat. It's chatting. Yeah.
It's yeah, did you see the like they hired 2,000 salesmen to sell AI agents? Like
Yeah. I
put
thought
an
the
AI
AI
to it?
agents yeah. Oh, okay. I guess those they're sell them and then replace them on their jobs. We had some questions, though, from the chat. Someone came in and actually asked this one on Twitter and in the chat, so I wanna hit this one. I actually didn't even know this was a thing, and I'll say maybe I can give myself a bogey here because I was on vacation, and it is a company I do own. So, Stefan says, "Hey, guys, apologies if you discussed this already. What are your thoughts on Jack Hartung joining Portillo's board of directors?" Do you know who that is? Hartung?
I don't know who that is, no.
That is the 22-year chief financial officer at Chipotle who recently retired. I would say, given Chipotle's track record, given that they're in the same industry and kind of trying to do a similar thing and expand nationally, that this is a very good thing. And I would hope that he would maybe want to join an operational role, given uh, like that 22-year run at Chipotle was fantastic. So I take that as and I think it was released, yeah, yesterday. I guess I didn't see it. I take it as a good sign.
Yeah, it's hard to see that as anything but good news. I mean, his track record is impeccable, and I mean, he's not really coming out of retirement since being on the board of anything. I have a hard time calling that coming out of retirement. I think that's more like what you do when you're in retirement. But nevertheless, having him as sort of an advisor and being able to give sort of best practices with his experience seems like a no-brainer, good thing to have. Do we want to shift gears to this, I guess, emerging share cannibals list?
Yeah. Yeah, let's do that. One before we do that, we have two questions here that we can hit quick. One's kind of funny. Says, doesn't investing in stocks just feel like loss aversion, confirmation bias, and hurting wrapped in the warm blanket of survivorship bias? LOL. Your thoughts? Thanks. Well, I
I
would
don't,
say stop overthinking it, whoever is sending that into us, and decide to index or just have fun. Because I believe that you can get all complicated in all these psychological things and how a lot of people overthink this type of stuff and either invest in some stocks you think are cheap. Hopefully they do well. Don't get overly frustrated if you're trailing the market for a bit. And if you don't enjoy it, just index or buy a 60/40.
Yeah, that question kind of put my brain into a pretzel there. It does. You may be kind of
Could be right. Yeah.
reading into it a little bit too much, would be my opinion, and I agree with Brett. You know, if this, if you find kind of chasing down stocks and looking for kind of undiscovered opportunities or promising businesses, all that like intellectually stimulating, you like that, you enjoy that process. I say go ahead and invest in stocks. If not, if it's not fun for you, if you're not enjoying it, then there's no harm in indexing.
Okay. And then the other one, do you think tobacco will do good if we see higher interest rates for longer? I would say perhaps, but that's not what we focus on.
I think tobacco will probably do all right regardless of the interest rates. I bet if you put together like a tobacco revenue versus interest rate chart, there would be zero correlation over the last 100 years, would be my
Yeah, it's on,
prediction.
and some people say they do better in recessions. So maybe it's,
Yeah.
well, actually, when are you raising rates? I don't know. It's all too confusing. They do fine. It's a consumer durable. It's an addictive product. It does fine throughout market cycles. All right,
Yeah,
you
there
ready for
is.
your or go ahead, Ryan.
I was just going to say, it is. We've talked about this at length on this show before, but it is kind of a unique time for the tobacco industry where you're seeing like this disaggregation between companies that have real viable new product line type businesses, kind of the new tobacco age, if you will, and ones that are purely legacy portfolios, legacy combustibles, that kind of thing. You're just going to see real sharp difference in volume growth would be my expectation. So I would focus more on like their actual product portfolios and where they sit as opposed to anything macro related for them.
I agree. I agree.
Shall we do this share cannibals list?
Yes. Yes. What? Let me just introduce it for you. You got 6 stocks here. These are
Mhm.
kind of the lists you do from our friends at FinChat. What were the criteria? Why do you think this list is important? And yeah, what fascinates you? Why do you think these are promising criteria for a stock you might want to buy?
Yeah, the goal here was that t- basically to find companies that are buying back more stock than they ever have while simultaneously trading at record low valuations. Um, to kind of hopefully that's, you know, sort of a perfect combination that leads to good returns. There, I've got six here. One of them, the first one here, this is in no particular order, is Alibaba. We have kind of a no China policy. It trades at a cheap valuation for a reason because American investors have kind of soured on Chinese markets, um, and I think justifiably so. But they are ramping up buybacks for what it's worth. If you're Alibaba here and you want to reinstill confidence from American investors, I would suggest a dividend to actually give them the cash.
I think they have a small dividend.
Okay. Then, yeah, I would plow it in there because you're going to at least actually give them some cash they can take away in case there's any sort of terminal risk. But the second one here is Match Group. Now, keep in mind, a couple of these, I think a lot of them here are actually software businesses. So you get a lot of stock-based compensation as well. But nevertheless, seeing a good increase in buybacks is typically a good sign, especially when it's coupled with low valuation. But yeah, Match Group has a current buyback yield of 9%. So number of shares being basically dollar amount of buybacks compared to the market cap. They trade at an EV to EBIT of 13 times, and they did just pledge to basically buy back a ton of stock at their latest investor day. We have talked about Match Group so much on this show,
We're
and
scarred. I think we're scarred, and that could be an opportunity for someone else. I think we're kind of. I don't think we see this one clearly, and if someone comes to this one with fresh eyes, there could be an opportunity here. But I gotta say, it's just I got to stay away from this one for now.
Yeah. It, I think we were just blinded to the Tinder problems. And this is one of the companies where it would have been nice to have the alternative data actually, I think, was a good leading indicator. Like the alternative data providers were showing like bigger Tinder usage drops than Match Group was kind of reporting.
Well,
And
that
also,
they were letting on, right? Because they
yeah,
weren't they just never shared those usage numbers.
yeah, exactly. And they would kind of like occasionally mention the users in passing. And it seemed like they were maybe only doing that when they wanted to during like calls and stuff. So, y- yeah, I think it was kind of kept under the rug how much users Tinder was churning out or losing each quarter. But if that can flatline, you've got a real, I think, promising business that can grow cash flow over the foreseeable future. But the third one here is PayPal. They have a 6.3% buyback yield. They're not at a record low valuation. They are all time. Here, I'll share my screen here. They've bought back more stock over the last 12 months than any other 12-month period. 16 times EBIT. They are buying back a lot of stock. And I've actually kind of flip flopped on this company because my thought here was basically that they're getting disrupted by the wallets, the Apple Pays and Google Pays of the world, which they probably are to some degree. But the financials still look pretty solid. And the Braintree business, I think, can improve because right now they kind of have low take rates, if I'm not mistaken, or they're like discounting relative to the Addians and the Stripes of the world, but they're seeing a lot of volume growth. And I know we don't get like super clear numbers on it, but I think there might be some value in PayPal.
I could see it working. Yeah, it's
Yeah,
the same concerns I had a couple of years ago are the ones I have today. But a couple of years ago, it was at 40 times earnings, and now it's at what, 16? And they're returning a lot of cash to shareholders. So you're getting compensated for a lot of that risk today. And perhaps that makes it more interesting. And they got a legitimate CEO now that seems to be more on the ball.
yeah. Although it does seem that people say that every time they get a new CEO. Like last
Yeah,
time,
grass is always greener. Yeah.
yeah. Okay, let's go through the last three here. Altria's up there. I mean, they always trade at kind of a cheap valuation, but the buyback yield, and keep in mind they pay out majority dividends. Um, so I think the dividend yield ballpark's
8%.
like
I just,
8%.
yeah, I just looked it up.
Okay. The buyback yield is just under 4%. So between buybacks and dividends, you're getting a healthy return back to shareholders. And then the last two, number five, and this is the one from the list that piques my interest by far the most. Adobe. Adobe bought back over the last 12 months $9 billion in stock. Now, keep in mind they do pay out a good chunk in SBC, but the buyback yield is just under 4%. They are trading near their lowest valuation in a decade. I think they actually might have hit their record low valuation. There was kind of some gap accounting stuff that may have inflated earnings a bit. I think there was some sort of a tax payment with the what is it, the
Right.
Figma
One time
acquisition that didn't
tax
go
thing.
through.
Yeah.
Um, but the narrative around Adobe is that this is like the one company who's most poised to be disrupted by AI, and I kind of would take the other side of that. I think that we had that conversation with Sean Wang, who's really bright and he's kind of a
It's on the
has really
ground in AI. He's at
yeah,
the forefront with the
exactly.
startups.
But I was having a conversation with someone who listens to the show, works at Adobe, and he kind of raised a good point, which is just that like if the thesis is that AI is going to disrupt code, like it's going to make it easier to write code, I think it's going to be a lot easier. It's going to be that's not going to be one of the first dominoes to fall, essentially. Like generating images requires very little review, right? You know, AI generates an image, you look at it. AI generates code, you have to spend all the time, basically as much time as you would have thinking about the code and writing it yourself to review it because it has to be good. And it's kind of when you're in the flow of writing code, I would imagine that you're thinking of the next line, all that, whereas you basically have to do this all over again and review. I just kind of don't believe that it's going to replace the development role that quickly. And so the idea that it's going to get easier and easier to write code and that's going to lead to a whole bunch of upstarts disrupting Adobe, I kind of just it seems more like speculation than any sort of proof in the numbers. Adobe's continues to grow, and it's not only through price realization, they're growing still predominantly through volume.
Yeah.
Um, and it's trading at a record low or decade low valuation.
Yeah, I don't know about Adobe. I'm not. I've never had a good take on it either way. Never been very bullish or bearish on them. I can see that argument working out. I could see this being a good buying opportunity. Anecdotally, though, we canceled our subscription for CCM, but that was really because we were overpaying for podcast editing, and that's not their core market. I don't think that's a harbinger of, you know, it was not very much money. However, I could see either side being right. I have no strong take on Adobe. I wish instead of Autodesk stock soaring, I wish we could turn Autodesk into a quote unquote AI loser and get rid of the management team. And maybe that would be a good buying opportunity. But alas, it's approaching $300 a share. Maybe
Yeah,
that one will be on the watch list forever.
yeah. It's you do see more and more companies kind of eating away at the edges of Adobe, it seems like.
Canva. Yeah.
Canva, Riverside, where we record our podcast software, it has a pretty useful editor that allows us to not have to go into their audio editing technology for Adobe, but there's nothing that offers the same bundle. So you can't get as much kind of if you're a creative studio and require more than one solution, I imagine it's harder to compete with Adobe in that regard. Last one here, because we're going a bit long, it's just Paycom. We've talked about them before on the show. I believe we did an episode here, but
You own them, right?
I do not,
Small position, starter
yeah,
position.
not a big position, but it's trading near kind of a decade low valuation and a 3% roughly buyback yield, which isn't huge. Um, but it's one of those where so I went into the office. I work for FinChat for anyone who is new to the show and has not heard me say that before, and spent a week in the office, and it gave me a newfound appreciation just for B2B SaaS in general and how much of the switching costs really come from the time investment into switching and how little companies want to do that. And if you're running your whole payroll on Paycom, it's going to be such a pain to switch to a new provider. Even if, and I'm not sure like if people prefer different payroll technology or whatever, but even if you did, it's it, it's so much easier to just stick with the provider you've got, even if they raise prices a bit on you. So that's kind of my it's
Yeah.
kind of a depressing thesis for Paycom, but yeah, it's a bit of my thesis.
Yeah, don't be an egregious price taker. Keep adding value to them. It can be a great win-win scenario as long as you just don't take egregious price hikes. The thing is, these businesses are so good, and I know Paycom is run much more efficiently. They're so good that they were all run, or 90% of them were run with, I mean, the expense line just so bloated, and it is frustrating. All right, we're going to get to another segment, Ryan. And I will say, you talked about the buyback plus dividend yield, which is the shareholder yield. That is one of my favorite metrics you can find at our friends at FinChat, your employer. I think when Ryan mentions that he works at FinChat, that should be, if it's that time of the day and if you partake, maybe that's the time to take a drink. But they have the shareholder yield that they calculate for you for every company, and it can be quite helpful, and it just saves a little bit of time. You can do that yourself with combining the dividend and the buyback yield together, but the way they do that for you for every company. It saves you maybe a couple minutes each time. That adds up, and that provides a ton of value. And that's why we use FinChat on a daily basis in our research process. And you get a discount using our code in the show notes, 15% off, and save yourself some money as well. All right. What other topics do we want to talk about, Ryan? And do we have any other sponsors we want to hit before we move on?
We should talk about the Blue Chippers Club. For anyone that doesn't know, Blue Chippers Club, this was started recently by two friends of ours with the goal of building a tight-knit community of stock-focused investors. Inside this community, everyone gets to share or break down their portfolio. They can participate in weekly calls. They can write up simple stock pitches, stock notes, and they can also compete in fun portfolio performance monthly competitions. I really do love this idea because it's basically with the big social platforms, you can get a lot of ideas, but I like having one that's a little more tight knit where you're actually sharing your ideas a little more in depth and you can actually collaborate with other investors. And there's just, I don't know, more of a takeaway there. I always had the goal of kind of building a network or community of friends to bounce investing ideas off of. And Blue Chippers does just that. If you're interested in joining, head on over to bluechippersclub.com and hit apply. Right now, it is completely free to join. We've had people reach out and say, how much does it cost? Where's the catch? It's free to join. They're just trying to get as many people into the community as possible. They'll worry about the rest of it later. It's actually a really just cool platform. So recommend checking it out. Link will be in the description.
All right. Let's hit a little bubble watch before we get to your small cap of the week. First one. Did you see Block, our good friend Jack Dorsey, surfer man on the beaches around the world with attractive women, getting caught with bottles of wine, walking on the beach, kind of looking like a shaman? He is changing his company's name, or excuse me, the ticker of Block to XYZ. Do you have any idea why? Is this because it's a conglomerate? Is it saying there's X, which the company that he founded that Elon Musk bought and changed the name from Twitter to X? Is this because his is XYZ? What do you think here? And should shareholders care? I guess it's just par for the course for this guy.
No, shareholders should not care.
They should know what they're getting into, I think.
Yeah, and it's one of those, basically, I only have two hard rules, I think, in investing. Maybe there's more, but there's two hard rules I have. No Chinese companies. I've been burnt with them before.
No apparel.
I guess no apparel, but that's
Maybe
not
that's
really
me.
a hard
That's
rule.
me.
And no Jack Dorsey companies. I'm sorry, it's not doable. This guy does not care. Like, shareholders are an afterthought. It's like there are people that run companies that I think primarily run them for like personal notoriety. And whether or not, maybe I'm making some assumptions about Jack Dorsey here, but I think he likes to feel important and
And there's a religiosity with Bitcoin. He's trying to be like push that out into the world and make it a thing.
He wants to be one of the people that's like a pioneer for it. And he just treats it he treats the company like a personal piggy bank, frankly.
Yeah.
And what I would be more concerned about is we have seen, let's see if I can pull this up here. So actually the seller ecosystem, the real Square business that kind of got things started. I'm pulling this up. The seller ecosystem has done a good job growing. They've grown gross profit. Although I will say, talk about serial adjusters. I don't know if there's any company that adjusts metrics more, but active users, monthly active transacting users, according to FinChat.io, is 57 million last 12 months. December 2023 is 56 million.
And only 50 million of them are drug dealers, according to Hindenburg.
There was some concerns that is a platform for facilitating illegal transactions, but
And the other
It's
6
kind of
million are pig
flatlining.
butchers. Yeah. Oh, it is flatlining. I think it's because they're getting rid of the pig butchers and that is the people that are trying to scam you for money. Like there's people that you've probably gotten the random text messages. Hey, how are you doing? Yeah, it's those people.
Yeah, it's I mean, I I don't th for the longest time, I was like, I don't really like Dorsey, but, Cash App's such a good business." It's just kind of, I think, lost a little bit of relevance lately. Maybe it's a more competitive field now, um, but
People just sell. They sell in the US.
what do you mean? Oh,
They
Zelle. I thought you said
Zell.
sell. Yeah, they do, which is mind-blowing to me.
I think
Also,
it's just
Venmo, it's really sticky.
Venmo is sticky. Yeah.
But no, I have no interest in Square whatsoever. They've done the name change now. They've now done a ticker change, which, you know what? That's probably not free. Like, I bet
True.
it costs money to change your ticker, and is that what really matters to Dorsey? Yes, but
Hey,
shareholders, no.
at least he's not a consultant guy. He probably just sits in his house and meditates and then goes, "This is our path." But the stock's trading at $82, and I remember this vividly. This is one of the first companies we ever looked at back in like 2017, 2018, and we had no idea about valuation then. And we're like, "Oh yes, this seems like a promising company. It's growing quickly. Revenue looks great." The stock was at $90 then. Revenue has grown quite substantially since then. Stock's flat. It's been almost in years. Are we in year 8? Year 7?
And it doesn't
It,
look cheap
really?
either. That's the thing that
Wow.
always blows my mind is like,
It's never cheap.
it's somehow the same price. They're somehow growing, and yet it's still not getting cheaper. Is what it feels like. Maybe, I mean, on a sales basis, sure, it's getting cheaper. But if you just are consistently worried about them ever really generating earnings and returning it to shareholders, what's it? I guess
Well,
it deserves a discount for that reason.
they gotta. I mean, Ryan, they need to be investing money into their Bitcoin cold storage product. This is where the money should go, not to investors. You have your small cap of the week, but I have one more bubble watch. And here's a quote. This is a more serious bubble watch with the AI data center build out. Here's a quote from someone on Twitter. It is requoting someone from UBS call with data center expert. And the quote is, "You have a 10-year runway and all that is booked out. I don't think we'll ever get to the point where we're overbuilt." That should be sirens in your head that we're going to overbuild. This is
Yeah,
exactly what the semiconductor industry was saying in 2021. And guess what? It went through a down cycle. It was the exact sign at the top when people said, well, semiconductors aren't cyclical anymore. Turns out they were. Look at Taiwan Semiconductor's revenue chart. At the exact peak when people said there was no cyclicality, that was the top of the cycle. Now, I don't know if this is the top of the cycle, but I love this comment from actually a past guest on the show, Simon Handran from MOS Investing, MOS Capital. And he replied, and I agree with this wholeheartedly, saying, "Thinking you will never be overbuilt is exactly how things become overbuilt. It's a story as old as time." True. Telecom, railroads, electricity, utilities. It's following the same story as always. But that's my thoughts. What,
yeah.
what are your thoughts?
I do think there's some risk that, well, for the cloud compute, like data centers, those like offering elastic compute, long term, 10 years out, I imagine it's a bigger business. They're running
Oh,
more
yeah, for sure.
workloads, much bigger, much higher revenue. I don't think that's a controversial take in any way. But I do think you're getting a lot of AI is driving a lot of extra workloads and training and compute costs to
80
the
billion.
data centers that might not be. Maybe it's, what's the old quote that like the internet will be, people underestimate the implications in the long run, overestimate it in the short run. It could be the same here with these AI workloads, and maybe it continues to grow. But there could certainly be a cutback in terms of those costs, which would lead to, I imagine, a deceleration in AWS, Azure, GCP revenues.
And they're fixed cost businesses, so if you overbuild, we saw that with Amazon, their profit margins went to basically 0 in 2022. I think yeah, I got nothing else. It's look, $80 billion for Microsoft this year. $80 billion on data centers. Eventually, we hit a ceiling. Someone's saying that we have a 10-year runway and we're never gonna get overbooked. That's not focusing on return on invested capital.
No, and no one can really forecast that, actually. I imagine no one can say they have a 10-year runway with certainty. The I have become I was a bit of an AI bubble truther. Like, I was kind of a believer in that for a while. And maybe overall costs, yes, it could come down, or overall money spent on AI training, that kind of thing. But I'm moving more and more. If there's a curve of overestimate in the short term, underestimate in the long term for AI, I'm moving more and more to the underestimate in the long term. And it's probably some bias, but there's it just feels like it could really replace a lot of redundant work.
I hope so. It'll open up people up to more fulfilling lives. The usage is there. The fact that OpenAI said that they can only be profitable with their advanced model if they charge people $1,000 a month, that's where I get concerned.
Yeah,
All right, we're running out of time, but we do have some other segments to get to, Ryan. Do you want to hit our small cap of the week presented by Yellow Brick Investing?
definitely. Yes. As Brett mentioned, this is the small cap of the week presented by Yellow Brick Investing. If you do not know, Yellow Brick Investing is one of the best places to find high quality stock pitches across the internet. They track thousands of blogs, newsletters, fund letters, podcasts like ours, and more to collect and summarize the best stock pitches and bring them to you in a single place. Basically, if you are running out of ideas, maybe you feel like, I'm not finding any sexy new investments, nothing that's catching my eye, just go to joinyellowbrick.com/chit chat if you want to give us a nice little link click, and I guarantee you'll find something interesting. But the company this week is Raspberry Pi. I believe someone actually reached out to you telling you to look into this, right?
That is correct. And I thought, I used these in college for a little bit of engineering projects. And
Really?
when you learn that, I don't know, when people get embedded in a technology or software while in school, that's a good indicator that there could be switching costs because of that educational advantage. Autodesk, Adobe, stuff like that. So that was an indicator I should look at it. And little spoiler for your numbers here, they look good. I mean,
Yeah,
it
really
looks like
good.
a good business.
Yeah. I honestly had no idea what this company was. It's not a bakery. It's not a bakery conglomerate, if that's what you're picturing.
Yeah, no raspberry tarts here.
Yeah. Although it is based, or it's listed on the London Stock Exchange. But here's a quote from from one of the Yellow Brick write-ups. Says Raspberry Pi is ubiquitous in the tech world, yet virtually unknown outside of it. They make computers and related computing hardware. They also make their own operating system, so it is a computer company, except their niche is that they make tiny computers called single board computers. If you look up Raspberry Pi, you'll see what these look like. If you're not well versed in tech, like me, I recommend checking it out because you're probably picturing a Mac or something like that, and it is really these like tiny little uh, almost look like raw semiconductors
It's
type
like
of
a raw
thing.
motherboard almost,
Yeah,
tiny one. Yeah.
yeah.
It's for
Uh,
robots, stuff like that.
yes, and it has essentially just become uber, uber, uber popular with like the hardcore developer community, engineers, hackers, that kind of thing, which is always a good sign. And they aren't super promotional. Like I imagine most people don't even. Yeah, we just got a comment here. Never knew they were public. Most people probably don't know they exist, or at least are available to public market investors.
Gotta love
Here,
London. You gotta love they just they gotta get some of their stuff in order over there. I mean, the valuations are insane, but sorry, I'm interrupting. Continue.
yeah, it says Raspberry Pi designs products to be disintegrated, which allows customers to only pay for what they need without being forced into buying more expensive products that incorporate seldom used parts and features. Costs of products are kept very low by using things like commodity parts and older process nodes for chips. I know this is getting a little more technical, but it says they're not trying to compete with typical computing companies. Instead, they're playing almost entirely at the low end of the market. Dot, dot, dot. This is not for data centers. The part that attracts me is so apparently the company started by really attracting the engineer, developer, hacker audience. They actually have the second biggest, like I think, technical, like um, tech, what's it called, board on Reddit. So behind Apple computers, Raspberry Pi is the second largest. Um, and basically, a lot of those engineers, developers, hackers, they were using them at home for personal stuff, started to integrate them into their companies and use them there. And now about 75% of Raspberry Pis, I think it's $320 million in revenue, is now attributed to commercial and industrial customers. Now, the stock did jump 50% in the last month, which is a bit of a bummer.
Dang.
Uh,
I
yeah,
should have gone with my invest in that investigate the Druckenmillers. Sometimes that works. I was like, oh, this looks good, but I'll wait and research. If I whoever mentioned it, we communicate from time to time. If you bought it, congrats. Uh, seems promising. And it was fairly cheap back then, or ish maybe.
yeah. I mean, it's still reasonable. So the market cap is 1.35 billion USD, basically. They have generated 31 million in last 12-month net income. Although they've got 30 million in net cash, so let's call it a 1.3 billion dollar EV. The operating income is like I think 41 million last 12 months. So on an EV to operating income basis, um, 32 times trailing numbers. This is a business that has grown really, really quickly. Brett, maybe you can share the screen here on this chart from finchat.io. Basically, from 2014 to 2024, they've gone from $8 million in revenue to $320 million in revenue over that 10-year period, which is more than a 40% annual growth rate. And they're quite profitable, actually. I think it amounts to basically 10% net margins, a little maybe low teens operating margins. Um,
Profitable every year since 2018.
yeah,
Pretty
this is
good. Pretty
what I'll
good.
probably do some digging on. It's probably not something I will know like the end market super well on. Maybe it's the kind of thing that you still invest and investigate. Uh, but yeah, it actually started as a nonprofit, shifted to a profit and or for profit company, obviously. And now it's like majority owned, but like the owner is a charity, the primary owner. I don't know if that has any bearings on the investment thesis, but the largest shareholder is some charity organization.
I think that's good because they're not a charity, but they want to make as much money for the charity that owns them. I think that's fine. Incentives, right? There's alignment there.
Yeah, for sure. All right. Any other topic? Oh, I should mention Yellow
Yeah,
Brick.
let's mention public again, right?
Yeah, public as well. We mentioned them at the start of this episode, but if you are serious about investing, you need to know about public.com. That's where you can invest in everything: stocks, options, bonds, crypto. You can even earn some of the highest yields in the industry, like the 6% or higher yield you can lock in with a bond account. Public is a FINRA registered SIPC insured platform that takes your investments as seriously as you do. Fund your account in 5 minutes or less at public.com/chitchatstocks and get up to $10,000 when you transfer your old portfolio. That's public.com/chitchatstocks. This is paid for by Public Investing. Full disclosures will be in the podcast description.
I was checking out their 6 months treasury account. That's something you don't have to lock in as much as the bond account. And with interest rates rising again, could be a good place to park your cash, get much better yields than your high yield savings account. I was checking that out as well. They are right when they say they have really anything across the personal finance spectrum that you could be interested in. So go check them out. Okay, let's do a tease for earnings season because it's going to be getting right into the swing of things. I know the Q4 one after the holiday and New Year's season kind of starts right away, but we got just a little tease this week with Delta Airlines and their earnings. They're always one of the first ones. And I think it's an interesting one to look at: consumer spending, travel. I'm an airport guy now. If you didn't know, Ryan, I own one of the Mexican airports, so this is very important stuff to me.
Big
Uh,
news.
yeah, huge news. And as a little tease, we are doing I don't know if that's going to be the title of it, but portfolio shakedown, where we kind of interview, critique, ask questions about each other's portfolios and how we're looking at all the stuff we own in 2025. We're going to do that for a Wednesday episode, but let me go through these quick numbers here. The premium carrier put up accelerating results in Q4. There were two quotes I thought were interesting from the quarter. Quote, during the months of November and December, Delta saw 4 of the top 10 revenue days in the company's history and double-digit growth in cash bookings driven by both leisure and corporate travelers. Second quote, American Express remuneration. I can never say that one. Essentially, money they get from American Express for their credit card deals. That was nearly $2 billion, grew 14% year over year, and was supported by an acceleration in card spend and acquisitions. They're bringing down debt. EV is about $57 billion, and they're guiding for over $4 billion in free cash flow next year. Say they get $4.5 billion in free cash flow. That's an EV to free cash flow of 12.7. I don't think I would own airlines, but it seems like the travel industry is seeing no slowdown in demand. So that's good for airports. That's good for anything related to the industry. It'd be good for Boeing if they could start producing planes, but we'll see if they can do that. So yeah, I'd say this is a great indicator for the consumer economy.
Does American Express, does the stock change at all when Delta reports? Like, does it have reactions to it?
Yeah, I looked. I don't think they did, but I'm sure there's alternative data, and they're actually down yesterday. Look over maybe the last 5 days. Yeah, I guess they went down. But I would think that they would have gone up. I think that was more of an interest rate thing since they're financial.
Yeah.
But I took that as a good sign for American Express's business.
Yeah, I think that's a good sign for just consumer spending in general. Delta's kind of considered one of the low cost carriers, right? Or
No, they're
they're
premium.
premium.
Yeah.
Oh, it's South. I was thinking of Southwest. Um, but yeah, I am more. I'm curious about basically like the low end consumer, how they shake out in terms of spending, because we've we've seen a couple struggles in the recent quarters.
Discover. I'd like to see what Discover's numbers are.
Yeah, same with basically all the discount retailers. Curious what these will basically what their numbers will look like, and if there's any sort of trade down among the, I guess, middle market consumers as well. All right, though, I think that's about it. TikTok's getting banned.
We'll talk about
Um,
that next week. Maybe we'll finalize that. But
yeah.
we're going over an hour here. We're gonna cover. Hey, we didn't do this one on Wednesday since Ryan was on a work trip, but we typically do these Wednesdays at 1:30 p.m. Eastern time. Just calculate that for whatever time zone you are in. Do them live on YouTube and then go out. Well, the recording will be living on YouTube after that, but the podcast recording on any of your podcast players will go live on Sunday mornings. And we're going to be talking earnings season, any sort of investing news, stocks we're interested in, and any questions you have. So join the live chat, ask us questions on Twitter, and we're going to talk about all things investing throughout 2025. Let's hit the disclosure. We are not financial advisors. Anything we say on the show is not formal advice or a recommendation. Ryan, I, or any podcast guest may hold securities discussed in this podcast, may have held them in the past, and may buy, sell, or hold them in the future. Thank you, everyone, for tuning in, especially those that ask questions during the live episode or on Twitter. And we'll see you next week for another fun episode. Okay.
Sweet.
How was my